Okay, I see we are live. Welcome to our June investment outlook. Thanks, everybody, for joining us. The theme for today and this month is Bitcoin faces supply squeeze as demand climbs. And with us here today is my colleague, Katalin Tischhauser, Sygnum's head of investment research. She's here to walk us through some of the biggest topics driving the crypto industry. As always, all content and opinions presented in this live stream do not constitute any investment advice. So let's dive right into it. And we have a couple topics lined up for today's live stream, macro, Bitcoin, altcoins, regulatory front, as well as ETF approvals. But Katalin, let's talk about how about that Circle IPO last week. I think something that the industry talked about a lot, and there was also it was quite long anticipated, considering the fact that it was priced at just north of 7 billion and has been trading over the last couple of weeks north of 20 billion. We do need to talk about it. So what do you think? Is this the price dispersion that we talked about at the beginning of the year? We mentioned all the positive news in the crypto industry, but they were not reflected in crypto prices yet. And then there's the Circle IPO, and it had a very, very strong trading session. And is this the repricing of the mispricing in the crypto market that we saw earlier this year, or what's your take?
Yes, I mean, maybe it's too soon to draw that conclusion from just this example, because stable coins are a very strong use case that has a lot of support behind it, a lot of growth, a lot of intention by TradFi regulators, governments. So Circle is obviously a stablecoin company and with a highly regulatory compliant stablecoin. So I think maybe it would be too soon to read too much into it, but it's been super interesting. The price range prior that was discussed by bids they received versus what might be the price was between 5 and 20 billion, which is a huge spread. And ultimately, the IPO was priced around 7, and the market very quickly put it above the 20 billion. So I think very much, maybe those numbers, to be honest, when we first heard those numbers that the Circle IPO, could maybe come there, or there could be a trade sale at that level. I think those 20 billion numbers were considered pretty unrealistic by most people, and actually it turned out that's where the market pegged it straight away. So very interesting, but we'll have to see, because now quite a few crypto companies are lining up to do IPOs. They tend to be exchanges like Kraken, Gemini, bullish. So we'll just have to see if this is crypto everything, or if this was really just very specific to this use case.
Right, exactly. Yeah, if it's an idiosyncratic event, or if it was a stable coin pricing of the market versus broader industry pricing, right? Because a bunch of other industry equities that are traded, of course, reacted to the news, but nobody as strongly as Circle itself.
Right. Yes.
Okay. So
indeed.
Yeah, so super interesting to see, and let's see what the rest of the year brings. There's a couple more IPOs in the pipeline, probably. You mentioned a few of them. So yeah, we'll definitely have an eye on it, and we'll keep an eye on it. And we'll see what the rest of the year brings with respect to IPOs and in this market environment. Now, having turned the market from an idiosyncratic event, let's move a little bit more to the global macro side, right? On Friday, we had non-farm payrolls come out, more or less non-event, in line with what the market expected. But just an hour and a half ago, I believe, we had the CPI print and CPI core coming out a little bit lower than expected. Bond yields already dropped, risk on, asset prices reacted to it. And that ties into, of course, that was an anticipated number being released, because it ties into what has shaped the macro environment up until this year, and that has been the tariff saga, right? So to what extent has this picture of global tariffs changed, and what do we need to watch out for going into the summer months?
Yes, Yeah, let's, a lot to say on the macro, but let's talk about the tariffs then. And basically, it's a bit bifurcated now in terms of the markets versus the underlying economy or businesses. Market sentiment has really shifted on tariffs, and there is this taco trade, the Trump always chickens out trade, where basically the market trades these potential negative scenarios, or could be extremely dire scenarios, as that's not going to happen, and trades the positive outcome. And this trade has worked actually really well, and market sentiment is basically the market shrugs off a negative outcome on the tariffs front, even though we don't know yet really what the outcome is going to be. I would also say that, this catchy taco, Trump always chickens out, I don't think this is about chickening out, actually. And I certainly, Trump isn't in any case the kind of person who would chicken out. So I think it's just because it rhymes and sounds good. I think it's more that he is forced to back down, or the US is forced to back down from policies that were actually unfeasible to start with, or would have been very damaging to the US economy. And I think the fundamental underlying reason for this is that there is a conflict, a clash between geopolitical objectives and what is in the interest of the US economy. And the geopolitical objectives seem to have dictated the policy proposals, not the actual interests of the US economy. But these objectives are now not very realistic, actually, at all, with a hollowed out economy, with a weakened military. This sort of trying to maintain hegemony is not realistic, and then the policies that try to achieve that don't work in practice, and the US basically had to back away from these policies, but some more of them are being proposed. And the biggest example is obviously the trade with China, or trade negotiations with China, or threats of basically trade embargo, where basically the US has the weak hand. The US is so dependent on China for critical things, even for the defense industry, that actually, despite the trade balance, would have suggested otherwise. It's actually the US that has the weak hand. So all these threats that even recently, by Trump in tweets and so on, we're really going to punish China and so on, they're hollow threats, and that's how the market trades it. Now, how it affects the underlying economy or on the businesses is actually different, because uncertainty continues to prevail. There's fresh threats coming out. For example, the Senate is now, this is not the administration, but the Senate, threatening 500% tariffs on China unless they stop supporting Russia or buying Russian oil, or whatever. That would, of course, sink the trade negotiations, which are continuing actually this week and sort of moving forward. But these introduce fresh uncertainties, and then of course the US courts ruling Trump's tariffs unconstitutional in the first place, and then the appeal being allowed to proceed. And for now, they can stay in place, and they try to expedite dealing with this case to come to a final decision on this. But that all just introduces further uncertainty. It's actually the president, just to clarify this court ruling, the president only has constitutional powers to introduce tariffs in certain emergency situations. So claims have been made. Otherwise, it's the domain of Congress, because anything relating to revenues for the federal government, which tariffs are, is Congress's responsibility and domain. So Trump claimed emergency for these executive orders, but then there's a question. So it's also very hard to guess the outcome, because it's somewhat subjective what you call an emergency. How much of an emergency is an emergency? So we don't know. But for businesses, the bottom line is that the uncertainty continues to linger. I think we're going to probably, this is just a guess, but based on the realities and the dynamic, I think we're going to end up with reasonable policies, more protectionist than in the past, for sure. That's the trajectory, but feasible, reasonable set of policies, and the gradual divorce from China, rather than these kinds of shock trade wars. That would be my expectation. But the journey there is still, it's unclear, it's not yet complete. they haven't signed any trade deals other than the UK, basically. So businesses are finding it very hard to make investment decisions, business decisions, relocation decisions, and that is in itself a negative, and a negative dragging growth.
Okay, interesting. And so on that point about presidential power of implementing actual tariffs, was everybody just too nervous and too afraid of that he actually could implement that? Because looking back, it seems like it was what I would call almost typical Trump trade or a Trump reaction, right? He comes in with demands that are just super outrageous. Everybody is like puzzled by it, to say the least. And then he actually settles on something that seems reasonable. And then in the aftermath, we just realize, oh, he actually would not have the power to do that, right? So was this, and I guess we have to anticipate going forward as well. Will it just continue to prevail, or will the market be smarter now?
Well, I mean, I think the market's now on the taco trade, so that's now the prevailing sentiment in the market as far as, and it is part of it is this art of the deal kind of behavior, ask for something crazy that you never expected to get, and then come back to something you wanted in the first place, and the other side's relieved that it's not near as bad as as it started out as. Like, I think this is a tactic, but there is also, I think, those crazy. To be honest, we were saying this immediately when the first Canada and Mexico tariffs came out, and he was talking about fentanyl and immigration, which really didn't make any sense at all. If you think about what Canada can do about U.S. immigration, and all these kinds of things, and also what actually is happening with the drugs. Like, it's not like that, So, however, already then we said this, that they're claiming these emergencies with fentanyl and immigration to be able to claim emergency power. So that was the reason why they actually just wanted the tariffs, but the reason why they were talking about these situations with immigration and so on was so that they can claim it's an emergency. So that's a part of it. But also, like, I thought already quite early on that massive Liberation Day threat was actually a plan, not so much directed at all these various countries, basically every country in the world, including uninhabited islands and so on, but it was to get them to agree to certain things the US wanted that didn't actually have to do with trade relations, but an economic embargo of China. And this they were not getting in the negotiations at all. What was coming back is that wasn't going to fly. And so I think the US backed away from that objective. Yeah.
Okay. Wow. Interesting. Yeah. And while tariffs remain, of course, a global topic in the macro front, I think tying it back a little bit to that CPI print earlier today,
Right.
what are US specific fiscal or monetary developments that we need to watch out for?
Well, there's a lot going on there, and this feud between Elon Musk and Trump. This highlighted again, and a little bit earlier, the Moody's downgrade, it really highlighted the escalating fiscal deficit and escalating debt in the US, and the really dire situation on that front. Trump is again talking about how the debt ceiling should be abolished entirely. The costs of this, the one big beautiful bill, of course, that's passing through the Senate, are worrying. Doge's failure to achieve really almost anything in terms of cutting spending and reducing the deficit. All of this just highlight how grave the situation is in terms of the risks to the system. And what I would say in this regard, that the risks are so great, it would be system failure, which they cannot allow. So I think it's a safe bet that liquidity injections will follow. And actually, I think they are already on the way. We have seen, for example, the Treasury general account in the last 2 months was run down by $250 billion, which massively offset the official quantitative tightening that is still going on, which was about 37 billion over the same period. So I think there's already stealth QE and liquidity injections happening now. And Scott Bessent is highly focused on this SLR's supplementary leverage ratio, basically that was introduced after 2008, so allow banks to do more lending and also buy a lot more treasuries, which would be another way of injecting liquidity. So I think we can safely expect that, and also the consequences of that for risk assets, which is positive. And I think in this regard, for example, watching the CPI print or even thinking about the Fed rate cuts is a bit of a red herring. Rate cuts as a monetary tool no longer work very well. They actually often backfire, which we saw last September, that actually bond markets sold off sharply after the 50 basis point cut that was bigger than the market expected. And basically it's perceived as being fundamentally inflationary depending on the backdrop. But the backdrop now is that there will be some tariffs, they will be somewhat inflationary. So I think against that backdrop, actually a Fed rate cut would be damaging rather than yay, rate cut. Risk assets can rally. I think it would do pretty much the opposite, but I don't think that actually matters. Liquidity injections are coming, and also global liquidity is also doing quite well, because the tariff issues are generally slowing global growth, so governments respond with stimulating their economies. The lower dollar is, of course, making liquidity conditions much easier for the other countries around the world as well.
Right, exactly, and cuts would mean even a lower, more, and even lower dollar, you know.
Well, that has exactly that as well, but possibly higher bond yields, and bond yields are already doing rather badly. So they really don't need, you know, when the 30-year it's been above 5% and it's very close to it. It doesn't need another sharp sell-off in bond prices, rising bond yields, because it's getting to the point where that would be mortgages, business loans, the government's own interest expense. Bond yields are much more relevant in that regard. So I think watching the Fed rate cut right now is not the metric, but liquidity injections are definitely, I think, already happening, and there'll be more.
Okay, interesting. Yeah, so liquidity injections versus rate cuts is more what we should look at.
Yeah,
is there...
yeah. You know, it's like since 2008, these monetary policy paradigms have been breaking down, and things no longer work how they used to, I think, fundamentally. Yeah.
So is there anything out there on the macro front that is totally overlooked? Like what potential risk is there on the horizon for investors to look out for that nobody talks about these days?
I mean, I don't know if those risks are overlooked, but maybe the market is optimistic about it. But the geopolitical risks could work out really badly, and we do hear saber rattling here and there. For example, the U.S. Defense Secretary recently at the Shangri-La conference basically threatened China and sort of raised the prospect of, you know, potentially taking military action over Taiwan or some such. There's obviously the situation going on with Iran that is also raising that risk. So I think the markets basically are optimistic enough that these scenarios won't unfold, or certainly not in the near future. So maybe many years down the line it moves in that direction, but not very soon. But these scenarios, of course, would totally change the picture, and especially something like a war with Iran, because of what it could do to the oil price and then everything that follows from that. Right. You know, they could close the Strait of Hormuz, oil price $200, and you know, and then you can make your assumptions take from there. So it could be very problematic. Yeah.
Definitely have to see some cuts after that.
Yeah, and like we're seeing these negotiations about the the nuclear deal, and it's really not going very well, and it's just dragging on. And when it looks like it's breaking down, then it's not breaking down. We still continue, but this is really percolating. I think the assumption just generally is that none of this will boil over in the foreseeable future.
Okay. Super interesting. Yeah, let's move a bit over to the crypto specific topics, right? I mean, our headline for today was Bitcoin faces a squeeze. So Bitcoin supply is down and demand continues to rise for various reasons. Are these and what are the potential triggers for a next for the next leg of the bull run?
Right. So there's definitely this supply demand picture going on. Will that be sufficient to catalyze the next leg of the bull run? Maybe. I think it's more likely that we will need a stronger catalyst, especially against kind of summer doldrums. And we're at very close to all-time highs. We see quite a lot of selling coming in at these levels, just kind of long-term profit taking from. I mean, these are the kind of levels that are hard to then conclusively break through. And by breakthrough, I don't mean that we make another all-time high that's like a slightly higher, 114K or something like that, but really breaks through to 120, 130, 140. It probably will need a fresh catalyst of something, for example, a central bank starting to actually buy a major central bank, let's say, not a small country, starting to buy Bitcoin alongside gold reserves, or major central banks at least implementing the process, something like that. But it is possible that the supply demand imbalance in itself might also get us there, and we're really seeing such a squeeze on the liquid supply side. It's really quite incredible over the last year and a half almost. Basically, since the issuance of the Bitcoin ETFs, we have seen the exchange balances, which is the readily available Bitcoin that people can trade. It was over 3 million Bitcoin on exchanges at the time, and now it's just a touch over 2 million. So 1 million Bitcoin has been removed from the readily tradable supply, and we have seen this over the last 2 months as well, accelerating. Just over the last 2 months, these Bitcoin acquisition vehicles like MicroStrategy, and now there's a proliferation, more and more and more of these being set up. They bought 100,000 Bitcoin. That's about, say, 10 billion, let's say. And the ETFs have somewhat less, but a kind of comparable amount. And then we have seen other demand coming in as well, which we see through the increased stablecoin market capitalization. That's usually fresh money coming into the crypto market and then buying other crypto. So a lot of demand, but then it's also removing the ETFs and these Bitcoin acquisition vehicles. They're removing Bitcoin, and in the case of the acquisition vehicles, really permanently removing Bitcoin from the supply. Unlike the ETFs, if the ETF is sold, then the Bitcoin is sold on the other side. But these vehicles, they don't sell the Bitcoin if the shares are sold by investors. So we are getting into a situation where the liquid supply, which anyway is not that great, Bitcoin is really typically long-term held, and there's also quite a lot of Bitcoin lost, and the kind of the headline figure is not the circulating supply that is available. So but with these trends, we are getting to that situation, and as you say, the demand just keeps marching on. We just see more and more institutional adoption. We see new headlines. For example, JP Morgan now accepts crypto ETFs as collateral. That catalyzes more demand. The Department of Labor basically gave a more positive guidance for retirement plans to these 401k plans in the US to invest in crypto, and we're just constantly seeing this adoption, and we just see the inflows into the ETFs, the Bitcoin and Ethereum ETFs just steadily marching on. So as the supply gets more and more constrained, it is setting up the potential for a squeeze that could squeeze the prices substantially higher from where they are right now.
Right, exactly, because it all comes back to the formula, like if supply dries up and demand rises, then it usually means it goes into one direction.
Yeah.
Interesting. Yeah, I mean,
that's that's what we used to say on Wall Street is, why did prices going up? Because there were more buyers than sellers.
Exactly. Yeah. Sometimes in theory it might sound so simple, right? So yeah. And speaking about triggers, and now we're talking about potential price triggers, but also on the regulatory front, we've seen a few shifts, right? What continuous triggers have you noticed on the regulatory front?
Yes, like just really, good news there, and it's both legislation and regulation getting, well, maybe fast-tracked is too strong a word, but a lot of focus and with lots of hopes that they can conclude fairly quickly. This comprehensive crypto market structure legislation now is being repackaged in a new bill called the Clarity Bill, and that's making its way. It just got the green light from the House Financial Services Committee, going for floor vote. There's the hope that before the summer is out, that this might get approved. That would clarify a lot of things. It actually it's like the FIT 21 bill was, but it's just a bit more comprehensive, updated, and a better version of the FIT 21. And it includes things like that most crypto assets are not, they're digital commodities, they're not securities. CFTC gets a lot of jurisdiction rather than the SEC, and so on. So these would be very positive catalysts for the crypto market. We're also seeing the stablecoin legislation making its way through the Senate, and there's two bills in Senate and Congress, and that's also the hope, is that it would also get concluded fairly soon, maybe during before the summer is over. It had some headwinds because of conflicts of interest of the Trump family and members of the administration, which some legislators object to, and then sort of this has put some spanners in the work, but as far as I can tell, these bills are also progressing. So we could see quite a lot on the legislative front, and on the regulatory front, the SEC is not only working on a much better set of rules and feasible paths for compliance and all these things, but they're also offering to fast track to give a kind of exemption, let's say, immediately whilst they work out what the regulations actually should look like in detail. And there have been some good signals, for example, that staking wouldn't be regarded as securities transaction. Now, this is not official. This is an opinion from SEC staff, but all of these are very, very positive indications. And just generally, Hester Pierce, I think, mentioned recently in some forum that she doesn't see most crypto assets as securities. So this could unleash a lot of good tokenomic changes and innovation, and very good for most the rest of the crypto market, aside from Bitcoin.
Right, exactly. Hester Pierce has always been a strong supporter of the industry, right? And it's interesting when we talk about other coins and other tokens. I think that leads us straight into altcoins, which have not seen as strong of a rally as Bitcoin, and now Ethereum also has corrected a little bit on the upside. But can we see, like usually in the last market cycles, we've seen Bitcoin rally, and then there was an altcoin cycle. What about this altcoin cycle and this hype cycle, as we used to call it?
Well,
will it come? Is it coming? What's your take?
It always comes. Uh,
Okay.
I think, and in all asset classes, right? Like, I think market psychology is fairly predictable and it follows certain patterns, and there's always that periods of exuberance where you get hype cycles, and that would certainly, it's always the smaller assets, the less liquid assets. It's also in equity markets that get disproportionately affected by those exuberant market moves, and these keep returning in various asset classes, not just in crypto. I think the more interesting question, or even more interesting question to ask, is what kind of an alt season we might have, because with all this stuff we just talked about on the regulatory front, if the um, if the performance of altcoins is fueled by positive regulatory changes and acceleration of innovation and capital being directed towards these projects because use cases can genuinely take off, that's not a hype season, that's not a hype cycle. So if we see that kind of an alt season, that a lot of these projects catch up and maybe even leapfrog Bitcoin's performance because of fundamentals, that's not a hype cycle. So that would be something quite stable and positive and solid. That would be a sign that capital is finding its way to projects that now can offer tokens with good tokenomics that actually transmit the value to the token holders without the founders having to worry about going to jail or whatever regulatory action, and innovation and growth in use cases and so on. And there's a number of use cases that are primed for for such growth. But that is quite different from just kind of a blow off top exuberance hype cycle, which would likely actually go towards still the meme coins, because they are the fastest horse in that situation, because they're not tethered to any sort of reality. And for actual projects, the prices, yes, they can overshoot in when there's excitement, they can overshoot on the upside, but they're still tethered to how much revenue growth do you actually expect, and can that be realistic? Of course, with meme coins, there is nothing to anchor the price, so they can go 100x no problem. So if it's a pure hype cycle, then that's obviously unfortunate, and that's always boom and bust, and that would probably still favor the meme coins. But I am very much hoping that these regulatory changes would create an alt season that is not a hype cycle, but is a fundamentally driven alt season.
Right, exactly. And then that would affect other tokens than memes as well, ones that have a bit more meat on the bone and more meaningful reason for existence, correct? Yeah. Okay, interesting. On the last topic of today, I think we neglected it last time a little bit, but there's always the bridge between TradFi and crypto is, of course, easily accessible ETFs, right? So what were the latest developments on the ETF approval side that we've been observing?
Well, I mean, like actual developments, we're not really seeing very much, just postponements, and the SEC reportedly now actively looking at some of the applications. But I think what's more interesting is that there are now so many applications, I think coming up to 100. And so the SEC's thinking is going in the direction of having standardized rules. And that would be, of course, very helpful, much more pragmatic, and much more positive. Basically, uniform eligibility criteria, uniform disclosure requirements, and then it would be actually much like for equity index ETFs and so on, and that would make it actually then much easier and much more seamless to bring crypto ETFs as much as there is demand for them. So I think that could be very positive. We are also there's also a lot of talk, although the decisions have been postponed on that as well, but that staking would be allowed for ETFs, as in the existing Ethereum ETFs, but then also potential future ETFs if it's on tokens that also have staking. And that, of course, would be an additional positive for demand. I don't see it as kind of revolutionary, because the staking yields are are not necessarily that high. And because of the mechanics, the lack of liquidity, the ETF issuers, of course, couldn't stake all of the underlying tokens. They would have to judge maybe half of it or so. And then there's intermediaries delivering the staking service probably. So I think that it wouldn't make a massive amount of difference to demand, but it would be a positive for sure. It would bring some additional demand. So that would also be good news. And of course, why shouldn't you get the staking yield? It's like equity dividends or bond coupons for similar ETFs. So why should you not be entitled to it as an ETF holder? So that would be a positive step.
Yeah, exactly. Imagine you like a company, you buy the stock and you like it because it distributes a dividend, but you don't get the dividend. So you just like the stock without the dividend yield.
Right.
I mean,
Right.
that would be,
Right.
yeah. very, very
indeed.
So yeah, no, yeah. So and then the industry is working on it, and that's great that everybody gets behind that to hopefully have staked Ethereum ETFs or staked any other ETFs. So everybody that runs a proof of stake chain, yeah. All right, great. So thank you very much, Katalin. Was of course very, very interesting. Half an hour with you talking macro and putting things into perspective. That brings us to the end of today's live stream. Thanks everybody for joining in on today's session. Big thank you again to Katalin for unpacking and unwrapping those important themes. For a deeper dive into this and other important topics, as always, feel free to go to our website, download the June investment outlook that we just published by Katalin, and you can find it on the Sygnum's. Yeah, you can find it on the Sygnum's website under the Learn section in Research and Education. Also, feel free, since you're very tech savvy, to join us online on our LinkedIn community to stay up to date with launches, news, and research. Having said that, thanks a lot, everybody, again, and we're already looking forward to talking to you next month in July when the next update is around the corner. Thanks a lot.